very good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain, and the closing trades are looking pretty okay given the fact we are close to the highest point of the trading session and we are on track to close the month of July in gains. And this is the 5th month on a trot that the Indian markets will be closing in the green. But the big question, of course, is where do we go from here on? Because history tells us that after 5 months of gain, there is a bit of cool-off period, and that's likely to happen now as well, because that's what the cues from FIIs and technical experts are also telling us. What else is happening in the market? It's the outperformance from the broader markets that really continues today as well, because the mid-cap index is up 0.7%. The small-cap index too is doing all right. It's the frontline index and the banking names that were a bit somber as compared to the kind of gains that we have seen in the broader market, and the advanced decline ratio is also quite positive. Metals, they have managed to surge quite a bit. In fact, one of the top sectoral gainers today, that entire China push is something which is working out well for that space. And then, of course, IT stocks are also in focus. Surprisingly, the top two pullers for the markets today are TCS as well as Infosys. The IT index is up 1.25%. Of course, the news on TCS regarding the rejig has kept the stock high by 2%. And then Capgemini earnings globally, where they maintain their guidance, is also augured well for the entire sector. What is not doing well? The sore loser today in terms of the sectoral trends is FMCG. United Breweries is on the back foot on account of earnings. Britannia is also not doing too much. So a lot of these stocks in focus today. But I think the market sense, Nikunj, is what we discussed earlier. It's not going to be a runaway rally from here on. What we were seeing earlier when the month of season of summer was on, it was a different setup. And now that the rain gods have been kind, the setup has changed.
Anisha, see, history is no benchmark of any kind of conformity. It is only indicative.
Yeah.
How many times in the past, markets have gone up for 5 months on the trot?
Yeah, I don't remember.
It's only happened once or twice, right?
No, I think
5 months on the trot, 5 months together.
There are 12 instances.
How many years?
In the last 15, 18 years.
Yeah, I'm saying last 5 years.
Yeah, okay.
Last 5 years, even though we are talking about a market coming from a COVID debacle, even when markets were in this recovery mode because of COVID, 5 months kind of a gain you did not even see. Back-to-back gains you did not even see in 2020. So this is something which is unusual. And when there's unusual trend at play, you got to ask yourself why and what is causing that unusual trend. And the factors which are at play in terms of giving power to this unusual trend, how many of those factors are still at play? Factor number 1 was FIs were selling, well, they've turned net buyers. Factor number 2 was inflation was a problem, well, it seems to be peaking out. Factor number 3 somewhere was that what will happen to banks and what will happen to the shape of the economy, that's done well. Factor number 5, some would argue, was what will happen to monsoon, that also has been on the right side. My limited point is that a lot of concerns in the market, they would automatically addressed. There are no triggers in the month of August. If there are no triggers in the month of August, markets can easily move into sideways correction. Some volatility could make a comeback, or markets may just see some bout of profit booking. That does not mean markets will reverse. That does not mean we are in for a crack or a crash. That does not mean we are staring at a sharp reversal. My limited point is that based on my understanding of markets, Kunal's understanding of charts, Naresh's understanding of how technicals are moving, and our understanding of valuations, there could be a case where little bit of profit booking cannot be ruled out, and August really could be a plain Jane month rather than a excited patch. That's my limited point. Am I right, Kunal?
Well, yes. In fact, just to complement the point of view, the data points, for example, in October 2021.
Complimenting my data points, first time.
So, because I worked on the data, so that's why it's ready with me. So, October 2021, we ended that 5 month of consecutive. Next month, the subsequent month, we had flat returns, 0% returns on the Nifty. And then the subsequent month post that was negative 4%. So, and similar data points in the last 3-4 readings prior to that, 2017, 16 and so on and so forth, that we've seen a range of 1% to 2% broadly on the index for the subsequent 2 months.
So that's the limited point, that you are not in for any kind of a slump or a crack. You may just want to take it slightly easy. That's my only point. Viresh, what's your view?
So the view is index could remain sideways. There could be some bit of a correction, but stock specific action could continue to surprise. So it's time to be more stock specific. Yes, in stocks which have rallied 40-50% really fast, there should be some bit of a dip. Even a 15-20% correction would be normal. So point is, time is now to be more alert, and if you're not nimble enough, time to take some cash.
The point on the market, but it's been very, very earnings heavy for us. So let's welcome on board the first management on the show. Mr. Nilesh Kambli, the CFO at Star Health and Allied Insurance Company, joins us on the show. Hi, Nilesh. Thank you so much for making time and speaking with us. Just wanted to begin by understanding in terms of the growth, because what brokerages are saying that the gross written premium growth has been steady at 20%. And retail is something that you have been focusing on, but incrementally it seems that the focus is on SME as well as banker group business. Talk to us about how this will pan out for you.
Yeah, good afternoon, everyone. Thank you for having me on the show. For the first quarter, we have grown by 20%. 19% is the growth in retail against the market growth rate of 18%. So we continue to grow higher than the industry growth rate and continue to improve on our market share, which is 32% now. In terms of group business, we continue to focus on SME business, which is profitable. The loss ratios are pretty comfortable. The combined ratio is pretty good. We don't want to be in the large corporate segment, which is not making profits for us. Banker channel, we are very, very optimistic. We have signed up a new relationships with AU Small Finance Bank, with Godrej Finance. So we are expanding our relationship in this segment, and which will help us to grow in this segment. It's a profitable segment. Benefit product contributes very high in this segment. We are growing by almost 50% over the last 3 years, and that's our focus area.
Vacate the wholesale insurance bracket and you move to retail, could there be a dip in top line? Could there be a dip in aggregate numbers? While you may grow at retail level, but if you are vacating a wholesale business, it will come at a cost of top line.
So that has happened for us last year. From a 10% contribution from group health business, we have shifted to 6% contribution. So we have already vacated that space. The base is set for the current year, and from here we'll continue to grow in this segment. The idea is, along with SME and banker group business, we'll operate in the range of 10 to 11% on a scale of 100. So 89-90% will be the retail business, and around 10 to 11% will be group business for us. But that reduction has already happened for us last year.
The combined ratio worsened this time around. It came in at 98%, and if I have it right, your guidance for the full year was 93 to 95%. Are you looking at a sizable improvement from combined ratio here on?
See, we need to understand that this is a seasonal business as well. What is comparable is last year Q1 we had a combined ratio of 98.25%. This year the combined ratio is 97.8%. It's a 0.45% reduction in the combined ratio. Our loss ratio has improved by 0.9%. Expense ratio, it's again, the base is lower in terms of premium for the first quarter compared to the full year. And the fixed cost is sequential rather than year on year. So there is always a slight blip in expense ratio in the first quarter, but we are, it is in line with our expectation, and we are well on course to maintain the full year guidance of 93 to 95. We have taken a price increase in our flagship product, which is the Family Health Optima. The renewals are, in line with our expectations. The benefit in terms of earned premium, which, impacts the loss ratio, will come in the second half. So that will again improve our combined ratio. So, to keep it short, we are well on course to achieve the full year guidance of 90 to 95.
So if you move to a number closer to 93% on combined ratio, and just I'm bringing this benefit for our viewers here. Two ways insurance firms, they make money. First, the premium. Second is the total kitty which they get, and how are they able to run their treasury operations. If the combined ratio is more than 100, that means the insurance company is spending more than what they are actually earning. That's how I'm trying to simplistically, make it sound eligible for our viewers. Now, if you move from 97.8 to 93, that means you are making money in your insurance business also. So what will be the impact of that? Because that will be operating leverage which should kick in, right?
Yes. So to give a context to it, last year we had our combined ratio at 98.2%. For the full year, we ended at a combined ratio of 95.3. Q4 is the best quarter in terms of loss ratio. Our combined ratio in Q4 was around 92%. So as the year progresses, there are quarters where we'll have a slightly higher combined ratio and loss ratio, and then there are quarters where we have lower combined ratio. To give a number, last year we had achieved the underwriting profit, which is operating profit for insurance companies, at 205 crores. The industry as a whole has lost 31,000 crores. The insurance industry, the GI players and the health players put together. So this year also, with this kind of combined ratio in quarter one, we are well on course to achieve underwriting profit for the current year, along with the investment income. So we have a investment book of 13,300 crores. For the first quarter, we had a very healthy yield of 7.4% roughly, with an investment income of 250 crores. So both on operating side as well as investment yield side, we are doing profits.
Impact of high medical inflation. Everybody now wants to go to a better hospital. Because you have insurance, you want to perhaps afford the best you can get in that insurance bracket. And there is a serious medical inflation. How are you passing it on? By a simple price hike in your premium policy, is that been taken care of?
Yeah, so there is a multi-pronged approach when it comes to inflation. We have taken a price increase to counter it to an extent. What we are doing is we are negotiating well with the hospitals. While the price increase is slightly higher in the urban areas, in the semi-urban rural areas, there is not much of an inflation. It's a function of negotiating with the hospitals. It's a function of the volumes that we do with the hospitals. And we are able to negotiate some rate really, really well. So the overall inflation in our portfolio, we don't see much of an impact because of this price increase which the hospitals are taking. It's a retail business again. The element of fraud is very, very prevalent. With the kind of claims we have settled over the lifetime of our company, we have settled more than 90 lakh claims. We have a lot of intelligence and knowledge. We have developed systems which gives us triggers so that the benefit coming through the fraud control and management, that has been gradually increasing. So while price increase to manage claims ratio is one part of it, there are a lot of efficiencies, in terms of the hospital rate negotiation, in terms of fraud control and management. That is also helping us to maintain the overall profitability of the business.
Nilesh, just last question from my end. You talked about the price hike that you had taken, but any more on the anvil? And secondly, your operating expenses have shot up very, very sharply, both in terms of employee and other OPEX. What's the sustainable expense ratio you're looking at?
The first question was in terms of, sorry.
In terms of you already took a hike, are you looking at taking more hikes in your products?
Yeah. So in terms of price increase, what we do is we manage each and every product separately. Whenever a product touches a particular loss ratio levels and profitability or loss ratio levels and the profitability reduces, that is the time when we go in for a price increase. We continue to evaluate it, currently we don't see something in the immediate near future, but as and when the loss ratio increases, we'll take the price increase. To answer the question on expense ratio, if you look at our expense ratio, it is 32.4%. Vis-a-vis last year, it is 32%. And as I explained, the fixed cost is sequential. So the kind of investment that we have made in people and technology, that is slightly higher compared to the GWP that we achieved. But we believe that as we go on, this fixed cost will remain stable. The premium growth will continue to happen. So we are very, very confident of achieving the full year target of expense ratio close to 30%. And there'll be slight reduction or stable expense ratio compared to last year. It is basically the investment in people, technology. The digital business is doing well for us. We continue to do performance marketing on social media. So that is where the cost is taking place.
Let you go on that note. Appreciate you joining us on the show. Quickly, just wanted to mark a couple of stocks that just reported numbers and seeing big reaction. Dhanlaxmi Bank has seen a big spurt, and that's because the asset quality has improved. And if you look at the interest income, that too has increased for the bank. So as a result of that, that stock has shot up around 8%. On the losing side, it's Castrol, which is coming under pressure. So that stock is down in the trading session. It's down about 2%. And then, of course, Welspun India reported a very strong set of improvement in the profitability and margins. So Welspun India, the last time I checked, was up around 10%. Look at the spike on the counter, now comfortably above the 110 mark. Let's do one thing. Let's, slip into a very short break. When we come back, we'll discuss the auto sales as well. Welcome back. Well, it's all about autos this week, right from big earnings lined up to the auto dispatch figures for the month of July. That will be out tomorrow. So passenger vehicle is expected to see tepid demand, while commercial vehicles could see seasonal weakness. Shishti is joining us with a detailed preview of what to expect this month.
Well, yes, from the July sales auto data, we are not expecting much because this time the monsoon will play the key role in terms of the sales. Before coming to the numbers, let's have the segment-wise expectation that we have. On your screen, you will see that the passenger car segment, the small car discounts is inching up further. It's expected to be a tepid demand season this time around. For the commercial vehicle segment, a seasonal weakness could be at play and the discounts are inching up too. So on a month-on-month basis, not a great set of expectation on that front too. From the two-wheeler segment, because this year we have all the festive season pushed a little back. So for the month gone by, we are not expecting a good jump in terms of the rural sales and no particular push when it comes to the festive or to the marriage season. And lastly, from the tractor division, we are seeing a sharp correction. We are expected to see a sharp correction on a month-on-month basis due to the inventory build-up and also on the back of the monsoon season. So let's come to the numbers. Firstly, onto the passenger vehicle segment, Maruti Suzuki numbers, if you will see month-on-month, that could see an uptick of 16%, but that will be on the back of a low base. So once again, this particular month, the company is expected to bounce back to its original or rather the normal sales data. For M&M as well as Tata Motors, we are expecting a flattish kind of a growth in their passenger vehicle segment. Now let's talk about the commercial vehicle segment. Like I was mentioning, a seasonal weakness could be at play and the discounts are inching up too. So from the likes of Eicher Motors, VECV, Tata Motors as well as Ashok Leyland, we are expecting a decline of 3 to 7% on a month-on-month basis. So not much expectation on that particular front. Now it comes to the two-wheeler segment. An interesting play could be Hero MotoCorp because last month the sales were actually higher and this time on that high base we are expecting a sales jump of 8% on a month-on-month basis. But other than that, a bit of improvement in terms of the export sales data for Bajaj Auto as well as TVS Motors is also on cards. And for Bajaj Auto, TVS Motors and Eicher Motors Royal Enfield, on a sequential basis, we are expecting a flattish kind of a growth. And lastly, from the tractor division, a decline of 29 to 44% on a month-on-month basis is what we are expecting, and that will be on the back of the inventory build-up as well as monsoon at play. So these are the expectations from July auto sales data, so all eyes on that.
UPL numbers, 166 PAT, eating up all 463. Why? Write-off, or maybe there was something extraordinary which markets were expecting. I don't have the details, but the stock has not fallen, which means somewhere markets know that it's a tough quarter for the agrarian economy. It's been a tough quarter for globally some of the companies like BASF, Bayer. It's been tough for a lot of companies, and especially if you look at numbers which you've got for Rallis, all these companies' numbers have not been exciting at all. Sampath Reddy joins us. Let's take our conversation forward. He represents Bajaj Allianz Life Insurance. Sampath, what's your market view? What should one do? Is it time to take some profits off the table? Is the run-up too much and too quick?
I think we are right now cautiously optimistic. Given that if you see the interest rate movement, overall interest rates have been rather it's taking longer time in terms of peaking of the interest rate cycle. If you look back and see about a year back, most of us were expecting that interest rate would have peaked by Jan, March of this calendar year, and by now we would have seen the reduction in the interest rate, but that's not happening. Thanks to the very strong demand in the US and the very strong labor market, overall the GDP growth rate is coming much better, and the consumption demand has also been much better. So because of that, I think interest rate cycle peaking off is taking a little longer time. Because of that, we are seeing overall in the market the value stocks performing better. As you see, the interest rates remain higher and higher levels. I think the growth stocks are getting slightly derated, mainly because for the growth stock, large part of their cash flows comes from the long period of time, where interest rate sensitivity is much longer for them. I think because of that reason, there's been a little bit of shift from the growth-oriented, high growth sectors to the somewhat, I would say, utilities kind of been performing better. I think this trend will continue, given that high interest rate regime will last a little longer. I think we are right now preferring more of a value-oriented stocks as compared to the growth stocks. But in terms of, to answer your question on the overall valuation as such, yes, the overall broader market valuations are slightly on the higher side. I think FY24, if you see, probably 21 times PE, and if you look 1 year ahead, maybe around 19, 20 times kind of a PE multiple, which we are trading at today. I think it's slightly on the higher side. But given that very strong macro for the India as such, relatively we are the one which are doing far better in terms of globally, in terms of GDP growth, and with a very benign inflation. I think the higher rich valuation probably will continue to be there. From a longer term perspective, I think it's better to stay invested, even though valuations currently appears to be on the higher end of the spectrum.
The valuations are on the higher end of the spectrum, but you're cautiously optimistic. Tell me which are the sectors or spaces that you like where you still see value or where you still see the valuation are at least a bit more reasonable.
I think the banking as a sector, having a very strong fundamentals now. The NPAs are at a multi-year lows, and the margins are also at a multi-year high. And if you look at the valuations, they are pretty much in line with their long-term averages. So the banking as a sector appears to be very, very good. And also the pharmaceutical sector, which we have been liking for a while. And it looks like now the time is coming right for the pharmaceutical sector. And a lot of news flow that you see that globally, there has been a increase in the shortage of drugs in the US, and the US generics, which has been a pain point for the most of Indian pharmaceutical companies, seems to have bottoming out there. So that sector also, in terms of most of the pharmaceutical companies, you see the valuations are not very high relative to the valuation that we are seeing in the rest of the other sectors. These two sectors we particularly like. And automobile sector is also doing well, especially in terms of earnings growth wise, largely because of the low base effect. Barring, outside of this also we have, some of the small opportunities where, for example, for QSR, which is a sector we've been liking for quite a while, given that its long-term growth potential is very, very robust, irrespective of the valuation which we are there today. I think, that's one good sector from a longer-term investment perspective.
That thought, I wanted to quickly bring on board in terms of UPL because they have revised their guidance and it's coming downwards quite a bit. They're now guiding for a 1 to 5% growth. Earlier, they were talking about a 6 to 10% growth, and that's the reason that stock is tanking at the moment. In terms of the other guidance that has come in, they are talking about EBITDA growth of 3 to 7%. Earlier, the EBITDA growth was 8 to 12%. So there's a sizable cut in terms of the FY24 guidance for UPL, 1 to 5% of revenue growth versus 6 to 10% earlier, and EBITDA growth of 3 to 7% versus 8 to 12% that they had reported earlier, and that's the reason the stock is a bit volatile, though still holding up in the green. Sampath, just coming back to the conversation, chemicals, is this the space that you even look at? Chemicals, fertilizers, the entire agrarian kind of stocks?
Yeah. Fertilizer sector, we've been liking that. There are some good quality companies, especially companies like Coromandel, Bayer, etc. Some of these companies have got a very high return on equity, and these are the sectors. These are the companies which have been liking. We are not so much, I would say, the chemical or rather export-oriented chemical companies. We have not been, very much, I would say, on top of that. But fertilizer is something which we have been liking. As I mentioned, like pharmaceutical is also the sector we've been liking overall as an export-oriented theme. These are the sectors which we are preferring in the chemical side.
Why do you like utilities? Utilities do well when interest rates come down or when there is a problem in terms of growth.
No, I think what I was trying to say is that when the interest rates are high, some of the new age companies where the free cash flows tend to be far out into the future. If you discount with the a little bit of a higher interest rate and higher cost of capital overall, the valuations tend to come down. Rather, interest rate sensitivity is much higher for the companies where the cash flows are far out, whereas the interest rate sensitivity for the companies which are kind of utilities where the cash flows are more front-ended. Those are the companies generally tend to do well. I think that's probably one of the reasons why I think values outperforming last few days. I think that's why we've been sort of liking this sector in this junction.
Okay, thanks Sampath for joining us. Appreciate you joining us on the show. Let's quickly take stock of what's happening in the market at the moment. Well, holding up all right. It's not a bad picture at all. Yes, we're off the highest point of the trading session, but 19,700 is being maintained. So let's get the closing trades from our chartists as well. Nuresh, what's the closing idea?
So that would be a buy on NMDC. The stock has seen a huge price volume breakout today, making a 2 to 3 week high, and the stock had corrected from 130 to 105 in the last few months. Looks like setting up for a move back to 130 eventually.
So that's a take coming in. What about you, Kunal?
So that'll be a buy on ICICI Bank, expecting this private sector banking stock to start moving up higher. It's formed an inverse head and shoulder pattern on the hourly chart. So that's one of the reasons for suggesting this as a closing trade.
Okay, so that's the closing trade coming in from our chartist. On that note, slipping into a very short break. Don't go anywhere.
Shinoy John just now. Meanwhile, you got to look at UPL numbers. I mean, they were an absolute miss for the quarter gone by. They've cut their full year guidance. So what they've reported, they expect that the coming quarter will be better, but it will be much lower than what they indicated to us at the beginning of the year. Now, where is the problem here? It's not UPL, it's the entire agrarian chain which globally and locally I think is suffering. And the ancillary businesses are also suffering. Look at Balkishan Tires, exports to Europe, they've plummeted. Unique Part Company related with the agrarian economy, that has suffered. Rallis has suffered, Dhanuka has suffered. This entire agrarian economy, in a sense, or businesses which are related with agrarian economy, they've suffered. Chemical, agrochemicals, pesticides, specialized chemicals, I think the bull run there is now getting challenged. Deepak Shinoy, it's a space which you've tracked in the past. I think you have an investment in Sudarshan Chemicals, but it's a complicated space. And it's a space where I look at the numbers, very few good numbers and a lot of bad numbers.
Yes, indeed, Nikunj. I think the problem this particular quarter has been very surprisingly bad. We don't have too many investments, direct investments in the space anymore. In fact, Sudarshan was an old investment of ours. But what's actually, I mean, much as I've not tracked the space, I'm a little surprised by the relative scale of when we expected bad numbers. I haven't seen the UPL numbers fully yet. But I know that this has been a tough quarter overall compared to what usually tends to be a good quarter seasonally for such companies. I don't have any specific ideas on why this has happened. I mean, at this point, I'm not tracking the space quite enough to have clarity on this.
In this market, where are you booking profits in this market?
I'm actually not booking profits. We're investing a lot more. It seems to be that there's too much skepticism about this rally, but and especially when you're talking of the mid and small caps, but some of the results have been quite incredible. I think the news flow also is quite strong. I don't necessarily believe that we are in a euphoric territory. I just think we are in bull markets. And that the results actually show that there's actually some companies where they're probably in the early part of their growth phase. So look at the railways and defense players, look at some of the infrastructure players, some of the banks, the public sector banks themselves have demonstrated quite strong performance already. We're waiting for a lot of the others, but it appears like most of the stronger banks have actually done really well in terms of growth. The only troubling idea there is deposit growth is not quite as much. So I think in these spaces there is some growth and tailwinds happening. Individual company performance, of course, I think we have a bunch of investments that a lot of them have not yet announced results. So we're actually adding more to them as we see them perform.
Sure. Just take a look at the Nifty. There has been a sudden spike in the last 5 minutes, and that's been purely led by Reliance Industries. Pull up the intraday chart and the candlestick if we can of the Nifty as well as Reliance. Let's see what kind of up move we are seeing, because yes, there has been a bit of a vertical surge, and given that heavyweight, even a few points move is something that pulls the Nifty higher. So Reliance has now become your top puller as far as Nifty is concerned, and that is what is really leading the rally. The markets are up almost 150 points off the lowest point of the trading session. Deepak, a lot of moving parts for Reliance. I don't know where to begin with, right from the Jio Financial Services, wherein they are doing a tie-up with BlackRock for the AMC business. Insurance is something they're looking to get into. Retail, wherein perhaps the Qatar Investment Authority is looking at putting money. How should one look at Reliance now?
It's really a sum of the parts valuation here. We own Reliance, so very biased. But Reliance actually has a lot of sub-businesses now that are all at scale. The financial business is actually not even started. They have just about announced the BlackRock announcement. That AMC has not even filed right now. It will eventually be filing, I guess, whenever it reaches the point where they can. And then there is, that demerger has just happened. So that company is raw. They haven't even started lending or any of the other financial services activity yet. But the bigger businesses that are established are, of course, Jio from the telecom business itself, and retail from the consumer retail facing businesses. I think these are very well established. They're independently profitable. In the oil to consumer business itself, which was a little bit disappointing this quarter, but I think overall has a very, very strong revenue base. And it's one of the largest, oil to consumer businesses in India, as you say. So if you add these parts up, the total makes what Reliance is today. And then there were a bunch of other investments in media and in, a bunch of smaller but surrogate investments like Just Dial and so on, which are part of the retail ventures arm. I think as a sum of the parts, we believe at least that is greater than the price of Reliance right now. But I think the real value will come when they actually demerge these businesses eventually, which will happen over a period of time. And we are actually hoping that unlocks the value over time rather than just being one large monolith.
Okay, so that's the take coming in. Just hold that thought, Deepak. In the meantime, the financial space is quite active, right from IDFC First Bank to what's happening into other names as well, the likes of MMFSL and Piramal Enterprises, because Piramal Enterprises has been fairly volatile. So why not let's listen in to what the management of all of these companies have to say with respect to the outlook.
We do still believe that our margins will be, like currently it's down about, I think, 9 basis points over last quarter. It should be somewhere here. Even if it comes down by a few basis points, maybe 4-5 basis points, really we don't bother about these things because we have a pretty good margin already. We feel that our operating profit will continue to outpace our loan book growth. Our loan book, as you know, we guide for 22-24% in that zone. But let me just say our profit will outpace it, because we are getting the operating leverage.
We had said that we would bring retail to wholesale ratio 2/3, 1/3. And we were going to do that in about by 26, FY26, FY27. I think we will do it much faster than that, because as you can say, the retail is growing pretty rapidly. This quarter compared to the same quarter last year, we have grown our retail by 57%. And the trend continues for growing our retail.
And if the borrowing cost was to come down, I'm not even saying it will come down as much as it's gone up. But even if it was to come down over a period by at least about 50-60 bips in the next 3-4 quarters, that will straight away lead into our NIMs improvement. And you will clearly see that leads to the 7.5% that we are talking of 2 years from now. But I don't think any one of us are facing a yield pressure arising out of competition. I think what competition pressure does is to be faster than before, to be able to reach a customer, take the credit decision fast, deliver the services much better and faster is what we are seeing as a pressure point, if at all.
Look, a nice little surge even in L&T. And Naresh, L&T and Reliance, it's a potent combination because between them the weightage is about 15%. So banks may not chip in, and today they've not chipped in, but it is good old Reliance, and it's getting support from the new leader L&T.
So L&T has been a leader favorite. It could slowly and steadily continue towards 2750 to 2900 mark. So positive on L&T, but the move could be slower. Reliance is the most interesting one, given the fact that if you look at today's prices, say 2550, add up to it the 200-250 rupees of the other arm, it comes to around that 2800, 2850 mark, which was the high for the stock for the last almost 2.5 years. So if it can sustain about 2850 levels, it becomes a breakout right from the time it topped out in September 21. So whether it can happen now or going forward, that could be critical for the index because it's a 10% weight and could drive the index going forward. So watching out for Reliance more. The stock is giving indications by consolidating at the higher zones rather than taking a correction quickly. So Reliance Industries going forward, say if I were to adjust the same prices at 2650 odd levels, if it breaks out, that could be a huge move.
IT Pack, that's also showing quite a bit of strength today, whether it's TCS or Infosys. Kunal, would you call it a flash in the pan, a one-day move of sorts on IT, or incrementally getting more constructive on the space?
Well, it's getting a bit better for the IT stocks on the charts at least, because many of the stocks have broken past about their 3-day swing highs. Not just that, to complement this, even the indicators have come back towards, I think, a 1-week high post the results for many of these large cap IT names. So I think that's another positive. It indicates that, for example, when RSI gets you a leading breakout, it generally gives a first sense that the prices may have bottomed out, or at least the worst could be behind the stock prices for many of these beaten down stocks. So I think that could be something which could be probably playing for the IT pack. But the point is that it's always better to buy this when the prices confirm a breakout of their previous major swing highs. So I think in that regards, if TCS breaks past about that 3500, 3520 mark, that could actually be a better time bet rather than trying to anticipate that whether these minor rallies would convert themselves into big trends. So wait out for a confirmation. I think only about 3,500, 550 for TCS and such other similar levels for these IT stocks, large cap and mid cap IT names is where one should take a call.
34.24. So Deepak, the jury is not out. AI is good or bad. For those who like IT stocks, they say you are forgetting Y2K was supposed to be bad. It turned out to be great. Ramdev Agarwal is saying AI to Indians hi chalayenge. But then I've got folks coming from some of the big consultants. They are saying that AI will replace humans. So what should one do? Buy TCS, buy Infosys. These are great companies, great cash, strong ROS. But would you buy them at the downturn?
So I think, we own TCS, so obviously a little biased, but here's my take. There has been no technology which has promised to take away jobs that has not created more jobs in the process of doing so. I think AI is a weapon in the hands of the right user rather than an independently functioning entity by itself. So whatever AI turns out to be, it will need humans to handhold, lead, control, manage the process. They will not independently be able to do things. Of course, it means productivity can increase. A single person using AI can perhaps do the work of 10 people today. But that just means you'll get 10x the work that is required, because once people start seeing the scale of the things that is possible, the project sizes will just increase in quantity and in size and scope, rather than say that, I'm sorry, we'll just hire 1/10 your workforce rather than anything else. I think in general, work expands to fill the capacity, and as more AI comes, I think these businesses will actually do more business, like you said about Y2K. But it's not, Y2K is not the thing. Y2K was a very time limited concept. But think of telecom space, BFSI. More regulations may have always meant more work. More computerization has always meant more work for these companies. I don't think they will disappoint too much in that area. I think all of them will eventually have investments in the space. So I think writing them off because AI comes in is probably a bad idea. But yes, the nature of the business will change quite considerably from now to maybe the next 10 years.
Sure, and most of the IT companies have already geared up. Most of them have been talking about it for the last 6 to 12 months. And most of the managements tell me that in any conversation with the client, that's the top talking point. But the talking point also remains market for now. 200-point gain as far as Bank Nifty is concerned. It's IDFC First Bank, which is high by 4%. A large deal was there on Bandhan Bank. That's sitting pretty with a 3% gain. And IndusInd Bank higher by 1.2%. But we just got the earnings from Adani Green. So listen in from the management, Mr. Amit Singh as well. He's the CEO at Adani Green Energy Limited and talks about the earnings and the outlook.
At AGL, we plan to play a key role towards India's energy transition journey, while delivering in excess of 45 gigawatt renewable energy capacity by 2030. Our current operating capacity stands at 8.3 gigawatt, which is the largest in India. Further, with already signed PPAs and letter awards, we have the largest locked-in growth of up to 20.4 gigawatt. Our renewable capacity has grown at a CAGR of 33% over the last 5 years, outpacing the overall growth of renewables in the country at a CAGR of about 15% over the same period. Let me now switch our attention towards our operational and financial performance for Q1 24. On a year-on-year basis, our operating capacity has grown by 43% with greenfield addition of 2.5 gigawatt. This is enabled by AGL's project development approach that is underpinned by 3 years of advanced resource assessment, supply chain planning, and value engineering, a centralized project management and assurance group that enables simultaneous execution of projects across the geographies, and a cluster-based approach where we work, resulting in significant operating efficiencies. The sale of energy in the meantime has increased by 70% year-on-year to 6,023 million units, primarily on account of the robust capacity addition and best-in-class O&M practices. Revenue from power supply has increased by 55% year-on-year to rupees 2,059 crore. EBITDA from power supply has increased by 53% year-on-year to 1,938 crores, with an industry-leading EBITDA margin of 92.5%. The cash profit has increased by 55% year-on-year to rupees 1,051 crores. The run rate EBITDA now stands at a strong rupees 7,645 crore, with net debt to run rate EBITDA at 5.3x as of June 2023. We continue to focus on operational excellence to enable safe, secure, and sustainable operations throughout the journey. Our ENOC Center enables real-time monitoring of portfolio across the country. The AI and analytics-driven operations and maintenance approach has led to the achievement of these industry-leading EBITDA margins and a consistent high plant availability, thereby resulting in higher power generation at a low cost.
All right, let's take the conversation forward. Deepak is there with us along with Nuresh and Kunal. Deepak, from the fundamental standpoint, you manage such a big amount of money now at your PMS and especially navigate mid to large space very closely. Are you finding it tricky to look for really juicy risk reward kind of scenarios now? Because fact of the matter is that everything, has gone up in the last 6 months from lows. Which is one area which is completely bombed out in your view? Earnings are very bad shape. Cycle is just not favoring, is at the bottom of the cycle.
So to be fair, I don't like to look at it that way. I usually like to look at sectors that are already demonstrating performance. Probably the stock prices are at a high because in stock market prices go up in the long term because of inflation itself. And if you get a stock that's actually going up, it's doing exactly what it's supposed to be doing, and it has good business performance behind it. You add the two, you get a fairly good, interesting longer term story. You'll never catch the bottoms, but that's fine for me. I mean, there are other people who want to catch bottoms, but I'm happier, riding it when they've shown some performance. So right now, for instance, if you look at even interesting stocks like say a PFC and RSCN, we own them in one of our portfolios, but they're at 4 times earnings, and relatively speaking, their NPAs have come under control, and the lack of visibility on their NPAs is lower. They started looking to borrow something of the order of 5 to 6 lakh crores against a lot of the new green projects. So I think this kind of pocket of a re-rating of these, if you go from a 4 PE to a 5 PE with no change in earnings, you're still looking at a 25% jump in the underlying stock price. So that this re-rating can happen over a period of, let's say, 2 to 3 years. That's still reasonable in terms of plus you get the earnings growth behind it. So there will be pockets of opportunity no matter how high the markets are. And I think right now there is still a lot of opportunity, especially in the mid and large cap space. And also in the small caps. Small caps currently, actually, their P ratio at the small cap index is less than the mid cap or the large cap indexes. So they have shown earnings growth at a quite fast clip. The last 6 months, you've seen some stock price rises. So yes, of course, if you choose some stocks, you will see some correction in them. But I think if you're looking at a long-term story, now is also a good time to pick. India is actually at a very interesting stage where I think the next 10 years are going to be very positive for us. Longer term. So picking stocks,
because we are very close to the market closing, it's important to take BTST ideas, both Nuresh and Kunal. Nuresh, starting with you, do you like something to take home overnight position?
Both PSU stocks, first is a buy on NMDC, good price volume breakout here, stop loss at 115, target price of 122. Second is a buy on ONGC, a new 52-week high, as well as almost a 2 to 3 year high on a dividend adjusted basis. Stop loss at 174, target price of 182.
Kunal, what about you?
Hindustan Copper is the first stock which I would suggest as a buy. BTST trade targets 150, stop loss at 134, and NMDC is a buy from my side, targets closer to 124, stop loss at 113.
All right. Deepak, you must have caught the commentary of this 5-star finance today. They were already doing 30% growth. Now they have raised it to 35. What are the other companies which have similar business models to 5-star business finance where one should be keeping on radar?
So I haven't seen 5-star per se. We don't track it. But of course, 35 is even what I think Bajaj Finance did. So it's been quite a wild ride, I think, for anyone doing the personal retail space. Retail space growth has been at least 25 to 26% overall in the industry itself. Some NBFCs will be obviously higher. We found in general that the personal space has been seeing much dramatically more rising credit total overall aggregates. And I think the NPAs haven't started to show in any meaningful way. So it seems to be an interesting cycle where you might see the credit growth transition into realized gains for NBFCs and banks in the space. There are no signs of worry right now, but obviously every growth cycle comes with its own negatives. So one has to be a little cautious, I think. But in general, I would say the retail space is where the attractiveness is. Some part of it is in the SME space as well. SME space is very early. I think rural SME and general SME, I think there is a lot of space, space to grow. We're seeing some bank commentary also today that talked about it. Again, positive, but I'll wait again for to see whether the NPAs develop. But we do have positions in a number of players in this space.
Deepak, do you have positions when it comes to healthcare? And I'm specifically talking about hospitals here because this morning there was this note that came in from Macquarie. They have initiated with an underperformer, Apollo and Max, saying that the valuations are expensive. There is a regulatory overhang as well. How are you looking at the sector?
So we do have a position in Narayana Hridyalaya, which is Narayana Healthcare. They apart from what their India journey is, they also have a hospital in the Cayman Islands. And it's the early days. They're setting up more capex there, but the realizations in Cayman are actually something of the order of 8x or 9x what they can get in India in terms of revenues. Perhaps in terms of EBITDA also, the multiples are quite high there. And given the cost differences between that and the US, and they're in the same time zone as the US, you get a substantially cheaper surgery and inpatient cost compared to anything in the mainland US, which is, I think, one of the factors that might lead to medical tourism in the same time zone at a relatively lower cost than people coming all over the way to India. In the near term, the stock prices have gone up, so there may be some corrections. But I think longer term, this at least Narayana, I think should be valued at much higher than it is. As the Cayman Islands capex comes through and as some of the expansion within India also takes place. I don't believe they're too expensive. I just believe that the growth story is ahead of them. So some part of what we're paying today will be paying for that future growth as well.
Sure, point taken. That's the word coming in as far as healthcare stocks is concerned. Deepak, did you manage to catch that story on Kotak Mahindra Bank? Was everywhere in terms of how the RBI is nudging them to look for an outsider when it comes to the CEO position, but the bank refuting those stories. Do you think this could be a bit of an overhang for the stock, at least for the next 6 to 12 months till the time clarity emerges?
Well, I would say at this point, so we own Kotak just as this thing. But one of the things that I found in this case is, I think they will find an able leader to lead the bank. Whether that is an insider or an outsider, that should be left to the bank's board. whether an RBI can make recommendations on this practice. I'm sure they're probably talking to people and saying, okay, tell me the names of the candidates you have in place and all that stuff. Rest of it is a little bit of speculation about saying, oh, RBI is saying find someone external. Does that mean that there's nobody internal who can actually lead the bank? I don't think RBI would make such statements saying you don't have anybody right now that can actually lead the bank. It could be that they have proposed a bunch of candidates, and maybe the candidates that RBI is favoring are not internal. I don't know if that's the case. I mean, it's an entirely opaque to us. But all I know is that, given the stature of the bank, given the nature of Mr. Kotak's investment and, commitment to the business, I don't think this will be left high and dry in any meaningful way. The bank itself is quite strong from both an asset quality perspective and a capital perspective. So I don't think this is a cause for us to worry right now. Of course, more clarity will be welcome. So till that time, I think the stock will, do its own thing. People sometimes get bogged down by unrequired uncertainty. But I mean, this is too big an institution to say it's driven only by one person. So, I don't think that is the case. I think the bank will do well, regardless of, what the choice of CEO will be going forward.
Okay, so that's the take coming in as far as Kotak Mahindra Bank is concerned. Quickly taking stock of what's happening. Last couple of minutes left for the trade to end, and it's not a bad ending at all from where we started off and how the rest of the day was panning out. At one point of time, we were going to go below the mark of 19,600, so 19,750 should be pretty okay. But before we let you go, gentlemen, just wanted to take stock of what kind of positioning you will have on the market, Kunal?
So I think on the index fronts, we'll still maintain long both on the Nifty as well as on the Bank Nifty. In fact, my sense is that the Bank Nifty actually hit an oversold territory on Friday's trading session. And you look at today's recovery of 200 odd points for the Bank Nifty, tells you that maybe a near-term bottom could be at place for the banking index. Okay, so the bottom is made for the banking index. Watch out for that. But separately, in terms of sectors, it was metals which was shining. Hindustan Copper goes home with a gain of 10%. NMDC, APL Apollo, these were your big gainers. IT stock, quite a bit of bounce back today, 1.5% higher, led by Tech Mahindra, then TCS, Emphasis, Wipro. All of these beaten down names saw quite a bit of recovery. That entire powerful rally in the power stocks continues. So NTPC was up a solid 4% today. Power Grid ahead of its earnings was up 3%, and the entire energy space, the likes of ONGC, etc., were doing quite well in the trading session. Lots of result reactions really to deal with, but in terms of stock-specific moves, it was Welspun India that spiked as much as 9% after it reported earnings. We saw also a move come by in UPL, very volatile by the end of the trading session, choppy as far as the guidance cut is concerned, but goes home with a bit of a red tinge. And then BLS International, BEML, IRFC, these were your top movers. On the losing side, don't forget Piramal Enterprises. That stock goes home with a cut of around 6% despite the management saying they will not be participating in the buyback. There is still a bit of niggling worry as far as that is concerned. And then, of course, you saw some sort of profit booking on Intellect Design, Equitas Bank as well. But that's how we're wrapping up the day. Very, very strong in terms of the advanced decline ratio. The broader markets continues to outperform, and we'll track all of that when the market opens tomorrow as well. But for now, it's a goodbye.